Hello and welcome to this week's podcast with me, Michael Hewson, and my good friend, senior market strategist at Pepperstone, Michael Brown. We're going to talk about all things markets in the hope that we can help to bring value as we carry on giving our unfiltered view and take on what is happening across financial markets after Michael dropped his stapler on the floor by the sounds of it.
It was actually my pen, and I was hoping you wouldn't notice that. Very good afternoon, Jamel. I've gone Trump style with my massive Sharpie here this week, but there we go.
Is that also for the morons at the back who are hard of hearing?
Something like that. But yeah, I mean, I guess you could say markets are in considerably more optimistic place than they were when we sat down this time last week for our recording amid this, let's call it a fragile ceasefire that's still, touch wood, holding in the Middle East.
Yeah, I suppose you could argue that markets are adopting a glass half full. They're giving back some of those gains that we saw in the wake of this so-called ceasefire. I have my doubts about whether or not it can last or not, given the fact that there's not just a divide between the two parties and their demands. There's an absolute crevasse.
Yeah, they are a very long way away, and they can't even agree on the number of points that they want to negotiate because the US have put forward 15 points and the Iranians have put forward a completely different set of 10 points. So, I mean, it's clearly good news that there is a ceasefire, don't get me wrong, and obviously we want to see this come to an end as soon as possible. However, I think everyone's right to be a little bit sceptical. Of course, all eyes now on these talks that are going to take place in Pakistan over the weekend to see whether they can yield any further progress towards a sort of more durable peace agreement.
Yeah, I think it'll be glacial. I mean, as you rightly said, the gap between the two sides is huge, and you're not going to bridge that in a weekend.
No, you're certainly not.
And if people think they can, then I've got a super long bridge to sell you.
Yeah, exactly. I think for markets, it's more about making progress in that direction than actually. I don't think anyone in their right mind is expecting this to be done and dusted by Sunday night. I think it's more a case of, we've agreed on 3 of the 10 points, or we've made an agreement to talk again in 3 days' time, or whatever it might be.
Is there any crossover in any of the 10 or 15 points that each side are basically putting forward? Because I must admit, I'm struggling to see any. Anyway, before we go on, hold that thought. Oh, risk warning.
There we go.
Okay, so get the risk warning out of the way, then we can basically talk about any potential overlap in the various parties'
which could be a very short conversation.
Shall we say, which could be a very short conversation. Anyway, this content is for general information purposes only and does not take into account your personal circumstances or objectives. Nothing in this material is or should be considered to be financial, investment, or any other advice on which reliance should be placed for investment decisions. The material has not been prepared in accordance with legal requirements designed to promote the independence of investment research. Okay, so back to that previous point.
Yes, well, you asked me, is there any overlap? And I can answer that very easily. No, there is not really any overlap whatsoever. Either the public negotiating positions are very different from those that will actually be discussed in private, or this could be a bit of a hiding to nothing, or it's going to be somewhere in the middle. I guess it's only time will tell on that front, really. But markets, if you look at the price action that we've seen this week, markets are kind of, latching on and fully buying in to this optimism. The S&P was up 2% yesterday on Wednesday. European stocks were up 5%. Brent is back below $100 a barrel. The market is wanting to price in good news and wanting to price in a positive outcome here.
But the Straits of Hormuz is still closed.
Ish. They're closed unless you pay a toll. Potentially,
so it's
and
closed.
Probably smile and wave at the Iranians as you go through to, make sure they're not going to shoot you or something. We are still way off, the transit numbers that we were seeing pre-conflict. I think I saw a report earlier on, it was 7 or 8 ships, not tankers, ships. They haven't been classified. Went through on Wednesday, and I think pre-conflict, we were doing sort of 100, 110 a day. So we're still way off those levels.
Right, yeah, but who's the money being paid to? The Revolutionary Guard or the Iranian political, the politicians?
Well, this is
because there are different factions. Who is the US negotiating with, and can who they're negotiating with take any plan back to the revolutionary guard.
Yeah, and I think this is going to be the key, even when we get to the point in terms of, peace agreements being actually written down on a bit of paper, that's going to be the key question. It's all well and good someone from the Iranian authorities agreeing to that in a conference room. Are they actually able to sell and to implement that deal back home? That's potentially a very, very different, kettle of fish.
Yeah, I think we can agree on one thing. Even if the Straits of Hormuz opens, say, example, even best case scenario in a week or two's time, you're still not going to get full traffic in that.
No.
For a long, long time after that. And even then, I would suggest that an awful lot of people will basically bypass Hormuz completely and put together other avenues to transport things like crude oil, natural gas by creating pipelines towards the Red Sea. And I know what someone's going to say, well, what about the Houthis? Well, yeah, I mean, obviously that is a factor. But ultimately, I think this pinch point has been long ignored by the global economy for quite some time. And it's one of those things that can no longer be ignored. And other alternatives will have to, at some point, over the course of the next few years, be put in place.
Yeah, exactly that. And that's not actually, that's a very good point in terms of, what may happen in the Middle East, but also globally. You think, for example, Qatar has been a massive supplier of LNG, and even more important in that respect, since Europe kind of weaned itself off Russian gas in the aftermath of the outbreak of war in Ukraine. Is the world now going to look towards other LNG suppliers, be that from the US or be that from elsewhere, because they need to, well, firstly, make up the shortfall, because it's going to take a hell of a long time for these production facilities to come back fully online. But then secondly, of course, you've got the issue of, there was potentially a degree of complacency, a degree of, not quite being aware of the massive risk that is, present in terms of relying on the Hormuz so much. Now that we do know that, is there going to be cause to diversify your supply chains even more? I think there definitely will be.
I think that's one thing that COVID did teach us. Nearshoring, as opposed to onshoring, is going to be a much more indelible part of the global economy. I think someone ought to tell the UK government that, particularly when it comes to energy policy. But
well, I think the other thing is...
That's a rabbit hole that I really don't want to have to go down.
Not for a third week running. The other thing just on that is, we're talking about the lasting effects of all of this. Even if Hormuz again reopened tomorrow, we still have, or we have had, I should say, 6 weeks of high oil prices, high natural gas prices, high commodity prices, supply chain disruption. So the inflationary impact of that and the growth headwinds that will bring, they are, baked in at this point. We can have, assuming we get a peace deal, assuming things get back to some degree of normality, we can have increased confidence that those effects are going to be short-lived, which should dampen the need for any rate hikes, certainly from the Bank of England and the ECB. However, you're still going to see that impact the data, and we're going to discuss the US inflation figures later on, and we're going to see that as soon as the March report that we get later on Friday.
Yeah, tomorrow, if you're watching this today, or on Friday today, if you're watching this tomorrow. So let's go and have a look at what we're going to be discussing, obviously in a much broader sense. I mean, obviously yields are off their highs. I'm just looking at the UK 5-year yield, and it's now down at 4.34%, and it was at 4.75. So, that's good news in some part, but it's still well above the levels it was, or it was at, the end of February, beginning of March, where it was around about 3.7%. So, as you said...
Rachel Reeves or Tris Osborne done a victory lap about that yet?
Of course not. But we both know that at the end of the day, they only see what they want to see.
Well, I'm surprised they're not patting themselves on the back about the fact that the FTSE's about 200 points off its record high again, but there we are.
But that's largely because of BP and Shell.
Don't tell them that.
Anyway.
Build a windmill, it'll solve everything.
Yeah, exactly. Windmills in their mind. Anyway. So we'll look at today's US data. Well, actually, we'll look at this week's US data in the round, because I think it points to a US economy that's slowing and where price pressures are building. We'll have a look at UK markets. Obviously, we've seen a decent rally in the pound in the past few days, which should help in terms of softening the inflation shock, given that we're a net importer of energy and what have you, and they're priced in dollars. And then we'll look at the PMIs this week, which don't make for particularly happy reading. And then we'll look at the earnings numbers from Delta Airlines and Levi Strauss. Levi Strauss has sold their Dockers, mate, so never mind. I'm sure that'll disappoint you. Anyway, before we look towards next week and the start of earnings season in the US, with Goldman Sachs on the Monday, JPMorgan on the Tuesday, along with Citigroup, Wells Fargo, and Bank of America, and followed by Netflix on the 16th. Okay, and obviously we've also got Tesco's full year numbers, so that'll give us a good window on what the UK consumer is feeling, the competition that it's getting from Aldi and Lidl.
Yes.
And we've also got UK GDP for February, I think.
Yes, it is. Yeah. So again, pre-conflict, but I don't think that's going to be giving us a particularly happy story or optimistic story.
Yeah. And I've also put in there full year numbers from Saga.
So just because you've propped them up?
Just because I propped them up in February and March. But yeah, I mean, the cruising, as I say, we'll talk about that in more detail, but certainly I think there's a bit of a success story there, given the problems they've had over the course of the past few years, pre and post COVID. And now suddenly we're starting to see some significant growth there, certainly in the share price, and a return to profit as well. Okay, so that's what we're going to be talking about. So let's start with the US economy, because today's GDP numbers, well, 0.5. Who could have possibly predicted that?
Yeah, although it's from 3 months and 2 weeks ago at this point, in a quarter that had a record long government shutdown.
But
am I that bothered by it?
Yeah, but which in December people were saying was growing at 4%.
Yeah, I mean, I think the bigger takeaway there is that the Atlanta Fed GDP Now model is utterly broken, or for whatever reason, and so is the New York Fed GDP Nowcast. But I think there's not much by way of signal that we can extract from the numbers. I don't think.
Because it's stale.
Yeah, it is stale. The only thing I would say is that the downward revision means that the US economy grew just over 2% over the calendar year 2025, which is the slowest pace of growth that we've had since 2020. And of course, that was the year that COVID battered the economy. So, that's a headline that the media are going to pick up. To be completely honest with you, I don't think the GDP numbers matter too much. What I am a lot more interested in is the more timely data, because again, we had a relatively low initial jobless claims print, that kind of 210, 220 mark. But more interestingly, that continuing jobless claims came in at the lowest level since 2024, which was a really strong surprise. And that comes off the back of last week's jobs report, where we had 178,000 jobs added, unemployment down to 4.3%. So, yes.
Yeah, but why was the unemployment rate down, Michael?
Well, I was going to come on to that. It was because the labour force shrunk. So I think the overarching message is maybe one of mixed signals, where actually the data we're getting is relatively noisy, because on the one hand, you're looking at a release like the payrolls print, where you go, that's a really solid headline, but the details don't quite add up to that. You're then looking at slowing economic growth, but a continuing claims print that's at a 2-year low. So, for the Fed in wait and see mode, I don't think it's going to move the needle particularly much. And certainly for markets right now, I don't think it does either, because we're just squarely focused on what's going on in terms of the geopolitical situation.
Okay, let me throw this question your way. If the participation rate is declining and continuing claims are falling, what does that tell you about confidence in the labour market in the US?
Well, I think confidence in the labour market is very, very low. And actually, we can look at things like the quits rate in the JOLT survey, which is at multi-year lows. The jobs hard to get indicator in the Conference Board metric, that's not looking particularly healthy either. So I think
people aren't bothering.
Yeah, exactly that. And it's reflective of this idea that the labour market is stuck in a mood of no hiring and no firing, or very slow hiring and very slow firing. Companies don't want to let go of the labour that they have, but they also don't want to bring on new labour for whatever reason, whether that be concerns about the economic outlook, whether that be, AI improving productivity, whatever it may be. That's just the dynamic that we're dealing with. And you could envisage a situation where you have, relatively slow job gains, but still relatively strong economic growth. And that's an odd dynamic that we haven't really seen before.
Yeah, but I mean, something else that struck me about this week's data was price pressures. the ISM surveys, the prices paid components of not only the services sector, but manufacturing.
Well, I don't think
very,
we should
very hot.
Yeah, I mean, I don't think we should be particularly surprised by that because, crude prices have done 50% in a month or whatever. It would be more a surprise if prices paid didn't go through the roof.
But they predate that, though, Michael. They predate that. Those prices paid surveys were also that. I mean, we're talking March, but if you look at them in February, they were hot as well.
They have been bubbling away for a while. I agree. But again, inflation expectations are still pretty well anchored. The Fed aren't going to be cutting within the next 6 months. You wouldn't expect. It's one of those where I'm just not sure there's that much signal we can extract from it. Yeah, ultimately, we're looking at an oil shock. I think what is going to be important looking forwards is, do we start to see higher headline inflation seeping in to higher core inflation? Do we see it seeping in to higher earnings growth? Because that's when you get these second round effects. That's when there's a risk that a one-off shock turns into something more persistent, and that's when policymakers might have to respond. I think that's going to be what we need to watch closely in the weeks and months ahead.
I certainly have noticed that core prices have been a lot stickier, not only here in the UK, but in Europe as well, where core inflation is actually above headline inflation. Yeah, it's been slowing, but it's still well above headline inflation. And I think that's my concern going forward. It's not about, it's not about whether or not inflation will go shooting up. It's how long it will stay at current levels and remain at current levels. Because ultimately that's the biggest concern, is that people have been pricing in inflation coming down. It's not now going to do that. And as a consequence of that, what will central banks do?
Well, they shouldn't do anything.
I know they shouldn't do anything.
And I don't think the Fed will do anything because, you've got Jay Powell saying we're in a good place, we're well positioned, we can wait and see. I don't think the Bank of England will do anything because you've had Governor Bailey say twice now that the market's getting ahead of itself in this pricing in of rate hikes, and we've still got 30-odd basis points of tightening in the curve by the end of the year. The one that worries me is the ECB. They've made some very, very well-documented policy mistakes in the past. Is there really anything to stop them doing that again? I don't know. You've already got hawks like Nagel at the Bundesbank saying that every meeting should be live and we should be discussing a hike every time we get together and all the rest of it. It would be a policy mistake, undoubtedly, but part of me thinks actually that they haven't learned their lesson on that front.
Yeah, you know what they say, history doesn't always repeat itself, but it does rhyme.
Yeah, exactly that.
Anyway, okay, well, I mean, that's a conversation for next week's EU CPI, but certainly you've got Lautenschlager, who's also a German member of the ECB, pushing back on that Nagel view. Or Nagel view. So it'd be interesting to see how that dynamic plays out, particularly given the fact the ECB are due to meet on the 30th of April.
Indeed, yeah. But so again, we could be in a very, very different place by the time we get to the 30th of April. And, hopefully we are in a very different place by then. It's tough to make a call on that now.
You're the optimist. I really don't see that this is going to change.
I'm not sure I like this, newfound position of mine. The glass half full, the glass sun is shining, etc., etc. It's a very unusual place for me to be in. I must admit.
Maybe you got a bit of sunstroke, mate, from all the. You do look a little bit pink around the.
Yes.
Temples,
I was in the sun at the Oyster Shed on Wednesday night, and sadly, I caught the sun, which is why I look a little bit tomato-ish today.
Oh, you ought to give it back, mate. Anyway,
the old thinning hair, mate. I'm going to have to start wearing a baseball cap or something.
Tell me about it. I already do. Well, even if I don't, my missus basically, where's your cap? Put it on. Protect the barnet. Anyway, UK markets, brief respite, I think, this week for UK yields, but they're still well above where they were at the end of February. That's some of the data that we've seen. Services PMI weakest in 11 months. Input price inflation, its highest level since April last year. Construction, I mean, don't even get me started on that.
We're never going to get that. Was it 1.5 million houses that we're meant to be building or whatever it was?
I think we'll be lucky to even get
1.5.
I think we'll be lucky to get 500,000, let alone 1.5 million. But at the moment, from what the Bank of England is saying, they're not overly concerned. There's nothing in the credit conditions survey to suggest that they're worried about the UK consumer, which in a way is a good thing. But obviously that's for the first quarter. And since then, we've seen house prices, the latest house price survey, seen a big fall in UK house prices. Obviously, all those mortgage deals have come off the table. And of course, this month, the new tax and employment rules kick in.
Yes. Exactly that. So again, the data is reassuring, but it is also somewhat stale. You question what value can be extracted from that. I would also say, just in terms of UK movements and markets that we've seen over the last kind of week or so, maybe I was looking at some sort of 1 month charts earlier in the week, kind of covering the whole conflict period. Cable is now unchanged since this all began. Which just sums up the FX market, really, doesn't it? Let me stress, that's almost nothing to do with the pound whatsoever. It's very much a case of, we all bought the dollar as a safe haven, and now we've sold it again as, participants up their risk levels once more. But I did think that was interesting. Next
Same applies to Euro Sterling.
Well, I'm surprised that thing's ever moved, to be honest with you.
It's unchanged.
But yeah, it is going to be interesting because next week we get GDP for February, which again is somewhat stale. But we're really just looking now. I think the big thing for the UK is going to be what the Bank of England have to say. They seem to have gone into hiding once more. We could do with hearing from some members of the MPC as to how their views have evolved since the last meeting.
To be quite honest, I think they're right to keep their gob shut, because ultimately we pretty much know what Hugh Pill thinks.
Well, I'd rather not know what that utter clown thinks, to be honest with you. But
and we'll probably got a fair idea of what Swati Dingler thinks. So
the only thing I would say on that, and I do agree with that, we kind of know their biases already, but I think one of the reasons why we saw such a violent reaction in markets to the March MPC was because we heard from no one, and then they just go uber hawkish in the statement and in the vote for no apparent reason and with no signalling of it, which just creates unnecessary volatility in terms of the fallout from that. And then you're rushing Andrew Bailey in front of BBC News an hour after the decision. So, we don't need to go full on like ECB speak where we hear from 5 of them every day. But I think there's a happy medium of, trying to massage markets a little bit more than they do would probably be a wise thing.
Well, I think if they got their commentary correct, they wouldn't need to calm or massage markets. Their signalling has always been poor when it comes to communicating with the market. It was bad under Carney. In fact, it was worse under Carney.
Well, it was worse under Carney because he signalled quite a lot, but then did the opposite.
Yeah, exactly.
I'm
old enough to remember when he said the next move in rates would be down, and they hiked them.
Well, exactly, and that's why he was nicknamed the Unreliable Boyfriend, and the Unreliable Boyfriend is now Prime Minister of Canada. Prime Minister. So, yeah, we always knew he was a politician.
Failing upwards. Anyway, moving on. Because I think we've pretty much said all we need to say.
Before we damage transatlantic relations too much.
Honestly. We're only talking Mark Carney. I like Canadians. They're good people.
Yeah, it's just not your Prime Minister.
Just their politicians, a bit like the ones here in the UK, are crap.
Yes, exactly that.
Anyway, on that bombshell, let's move on to Delta Airlines.
Well, they've taken off, haven't they?
Well, they took off and then came back down to earth with a bump. Because they pretty much finished the day where they finished 2 days ago. Yeah, they soared quite aggressively yesterday, but they closed pretty much slightly higher, but massive, great big spike on the daily chart, which suggests that I think people got a little bit carried away. Yeah, and I think that was more to do with the fact that there was a bit of a relief rally on the ceasefire.
Exactly that. I was just about to jump in with that one. I think it is very much a case of the market was, basically buying everything kind of indiscriminately on Wednesday. Travel stocks are obviously going to outperform this huge relief rally that, we might have a bit of light at the end of the tunnel in the Middle East. It just kind of happened to be coincidental that Delta were releasing earnings in the middle of that, I think.
Yeah, I mean, the numbers themselves were fairly decent. Operating revenues at $15.9 billion, but they still slid to a pre-tax loss of $214 million on a GAAP basis. On a non-GAAP basis, total revenue was at $14.2 billion, a 10% increase, largely driven by premium clients, premium customers,
Yes.
which saw a 14% increase in travel there. They've also got their own refinery for jet fuel, which obviously saves them a pretty penny as well. I mean, obviously they still have to pay the market price for it. But,
well, I was going to say, it does save them a hell of a lot of money, but they are still expecting $2 billion worth of higher cost on jet fuel in the coming quarter as a result of, the move that we've seen in the markets, which, you kind of then try and read that across to other airlines. You'd expect their burdens to be similar, if not higher. And of course, the other thing they were saying in terms of the guidance is that they're looking to, well, the CEO said, meaningfully cut their growth plans in the near term, which is, effectively a reflection of market conditions. So, again, the figures themselves and the commentary around it was probably not as optimistic as the initial pop that we saw might have suggested.
Yeah, they've said they've already cut capacity as a result of that. So essentially, I think that's probably going to be most felt internally within the US, forcing more people into their cars if they're cutting, inter-country travel. And they're also increasing their checked bag surcharge as well in response to the increase in aviation fuel, because obviously that adds more weight to the aircraft.
I believe quite a few of the US airlines have done. I think JetBlue have done similar. I wouldn't be surprised if they all go down that path eventually, to be completely honest with you. But we will see what happens. I mean, it's one of those where they are all the airlines, let's be honest, are so dependent on the path of the conflict in terms of their near-term performance that, it's ultimately out of the control of company management, I think.
Yeah, costs, essentially. And I would imagine that will probably be a similar story for all of the other airlines, though, again, geographical factors will play a part because Delta doesn't have a big Middle East presence.
Yes.
Operation, exactly. It's very much trans-Pacific, transatlantic, and Latin America. So
indeed. Actually, one point I did just want to pick on there before we move on. You mentioned about domestic travel routes being cut and forcing people into their cars, et cetera, et cetera. There's an interesting piece of research doing the rounds this week. I can't remember who put it out. It might have been Bloomberg Economics. It might be someone else. Apologies if I've offended anyone here. But it was basically working out that the increase that we've seen in gasoline prices in the US is almost exactly equivalent on average to the average tax refund that people will receive under the One Big Beautiful Bill Act, which was passed last year. So, I mean, that is purely coincidental before anyone thinks this is some sort of 4D chess that the administration are playing. But the point is that the negative impact on things like consumer spending might not be as considerable as we would ordinarily expect, because there is a little bit more of a buffer there than there otherwise would have been if those tax refunds weren't being paid out. So I think it'd be interesting to see how that one evolves as well.
So that's certainly an interesting, I mean, 4D chess, I don't think they're that intelligent.
No, nor do I. I think it's just pure, one thing just happened to be matching up with the other. I don't think that was planned in any way, shape or form.
But imagine what would have happened if we hadn't had the spike in fuel bills. How much disposable income US consumers would have had.
Yeah.
It's this is what you could have won. This is what you could have won.
Yeah, it's like bullseye, isn't it, at this point?
Exactly.
But you're right. You've basically gone from One Big Beautiful Bill was fiscal stimulus and a really positive fiscal impulse that was going to kind of put a bit of a jet under the bottom of the economy. Now it's almost fiscal relief to limit the damage that would otherwise have been caused. So, it's still a positive at the margin, but it's just not as much of a positive as it could have been, as you say, in true Jimbo-in fashion.
Indeed. Levi Strauss, decent rally in their shares after they raised their guidance for the full year. We haven't taken out the highs that we saw in February, but nonetheless, we are holding above both 50 and 200-day moving averages as a consequence of those numbers, and they look pretty good.
They did look very good, although the one thing that does concern me is the final line that you've written in terms of their guidance, which says they expect full-year profits to be between $1.42 and $1.48 a share, and this is the key part, assuming no worsening of macroeconomic pressures. Now, I know I've sat here for 29 minutes in a sort of glass half full optimistic mood. That's a pretty damn big assumption to be making in your guidance, given what's going on in the world, isn't it?
It is. And when I was writing that, and because I read it in the statement, I thought, good luck with that.
Yeah, it's one of those where, on paper, fine, that sounds good. But in reality, that's probably going to be a lot harder to deliver on, I think.
Yeah, I suppose it really depends on what your margins are and how much of that is built in. Did they raise their guidance as much as perhaps, were they conservative, in other words, in the way they raised their guidance?
Are they under-promising and hoping to over-deliver?
Yeah. Because they have sold their Dockers business completely now. And what I was struck by was that actually they saw decent growth in all of their markets, unlike what we were talking about last week with Nike.
Yeah, exactly that. I mean, maybe jeans are more popular than trainers. I don't know.
Sneakers, as they like to call them over there.
Oh, you're getting all down with the kids now, aren't you?
Never been accused of that before. Especially not with my nephew. He's 24.
Nor have I, for clarity.
Anyway, let's move on to next week. Okay, so no real surprises. We've got EU CPI for March. Again, we already pretty much know what that's going to be. The flash number showed us rising from 1.9 to 2.5%. The main driver there is going to be energy prices. But I think in terms of driving expectations, what will this tell the ECB about what's happening with the European economy? And are they going to be overly concerned about it, given the fact that energy prices show no signs of easing off, and more to the point, are unlikely to settle back to the levels they were at the end of February?
Yeah, I think that is an important point because, I think it was Kevin Hassett, the NEC director, was on television again earlier on today. As soon as he pops up, the mute button normally goes on. But he was talking about how gas prices and oil prices are going to go back to their pre-conflict levels. And I just struggle to see how that happens when, you look at the market, even if you assume that conflict comes to an end and Hormuz reopens and normalizes completely, right? Let's just assume that happens. The problem you've got is you have a greater geopolitical risk premium that is going to remain in the price for a prolonged period of time as a scarring effect, essentially, of what we've just seen. You've then got the potential for, is Strait of Hormuz basically a toll booth, and does that toll have to be paid? If it is, that's going to be chucked on the top of the price of a barrel of crude as well. And then you've got the fact that actually all of the inventory that's been drawn down since this conflict began, whether that be floating storage, whether that be strategic petroleum reserves, whatever it may be, all of that has to be rebuilt again. So you're looking at structurally higher demand post-conflict as well, because you've not got all the day-to-day stuff that we use oil for. You've also got people buying barrels of oil to basically throw it in the ground ready for the next rainy day that may come along at some point in the future. So we are going to go back to a higher baseline, I think, post-conflict, whenever that is. We hope it's soon. And I think that is a potential issue because, certainly not only from an inflationary perspective, because the impact that will have on inflation will depend on the rate of change. I think that's more important from a growth perspective because we're going to probably move into a period of time where spending on energy is structurally higher than it was 2 months ago.
Well, it's gonna be because obviously you're going to have all these producers who are rebuilding their production capacity, which was damaged. They're going to pass those costs on.
Exactly that. So that's another cost that you've got on top.
Yeah, because they're not going to pay for themselves, and insurance won't cover it because it's an act of war. And most insurance policies I tend to read tend to have an acts of war clause in them. Even my household insurance,
isn't it?
Yeah, exactly that. Well, I mean, the Qataris have already announced force majeure
for 3 to 5 years at Ras Laffan. Yeah, exactly. So,
but they're going to have to claw those costs back somehow, which means the baseline will be higher.
Yeah, exactly that. So that's certainly something to keep on the radar. As just to take it back to the Eurozone inflation numbers, I mean, we shouldn't expect any particular surprises in the data because we've already had the flash estimate. But I think the key thing to look at is not the headline metric. That will, without wanting to, make this into a pun, that will catch the headlines, but it's the underlying price metrics that are more important, the services metric, the core metric, the stuff that doesn't include energy. That's where you're going to get your signal from, and that's what the ECB should be looking at and should be reacting to on the proviso that they don't make another policy mistake, as we discussed.
And food inflation as well. I mean, again, that's a big concern for me going forward, I think. Food inflation not only in the EU, but here in the UK. And obviously that will feed into the UK GDP numbers for February. I mean, the UK economy flatlined in Jan, and that was despite a fairly resilient consumer. Some of the trading outlooks that we've seen from a lot of the major retailers have been fairly decent, but services, there was no growth in services in January for GDP. Administrative and support services were the biggest drag. Production was weak. Electricity, gas, steam and air conditioning fell 0.3%. There's a lesson there,
It's
Mr.
a very
Miller-Bennett.
niche sector, that one, isn't it?
Yeah, but there's a lesson there, right?
Oh, there's very much a lesson there. But we said we'd avoid that. I'm going to rein you in.
All right. So what are the expectations for that? Have we got an expectation for that?
We don't, but I can give you my expectations, which will probably be another month of flat to no growth. Effectively a rounding error away from stagnation and risks tilting firmly to the downside as we move into March and the impact of higher energy prices begins to bite. You've actually mentioned in your week ahead, which I will promote for you, people can read on your Substack if they want to, you've actually mentioned the R word, recession, which I haven't really seen anyone mentioning since the outbreak of war in the Middle East. But, you think about it, and I don't think it's my base case, but the economy's been like a rounding error away from stagnation and just been flatlining for the last 6 months or so. It's not beyond the realms of possibility that a shock of this magnitude does kind of tip us over the edge if it's prolonged.
Yeah. I mean, that was basically what I was basing that assumption on. The economy's not grown since July.
Yeah.
It's flatlined. It's on life support. And this is the type of shock that could tip it over. I mean, if anything, it's been remarkably resilient given the challenges that it's faced. But I think if you're looking to boost the economy, then granting new licenses in the North Sea for me, is a no-brainer. If you want to boost your balance payments and you want to boost jobs in the manufacturing sector
and your tax
and you want to promote investment. But unfortunately, you've got a chorus of voices who've got their own vested interests in renewables and what have you, basically yanking Miliband's chain like an obedient puppy.
That is a horrible mental image. Can we move on again?
Okay, let's move on to Tesco's. Let's move on to Tesco's full year numbers. Again, you've got the usual suspects complaining about the fact that supermarkets have been price gouging. I was pleased to see that a lot of the CEOs basically told Rachel to go and do one. Aldi and Lidl, there's this piece in Bloomberg this morning that was suggesting that Aldi and Lidl are certainly keeping that sector honest when it comes to mitigating the impact of some of the worst effects of the problems with the cost of living. I mean, I noticed it at Tesco's the other day, $1.56 a litre. But obviously with a club card and what have you, you can get discounts and what have you on an awful lot of stuff if you're a regular shopper there. I mean, I've got loyalty cards for pretty much all of them.
Oh, actually, on that, I don't think I've mentioned this now. This is, I'm sounding really excited. This is a proper nerdy thing, by the way. So this is not going to live up to the excitement that I've just delivered.
I'm going to clip this, and I'm going to be.
So just for the clip, this is the most exciting macro news we've ever had. The ONS, for their inflation data, basically they used to send a man probably in corduroy trousers round supermarkets with a clipboard to note down the sticker price on the shelf. They're now using what they call scanner data, which is basically what you actually pay at the till. And what it means is that the ONS are now capturing your club card and your Nectar card discount. So the inflation data that we get will reflect the price people are actually paying, not the price that it is on the shelf if you've been too lazy and not got your loyalty card. The reason why it's exciting is, one, it should make the data more accurate, and two, it may actually mean in the fullness of time that we have been somewhat overstating food CPI here in the UK because we've been looking at the sticker price, not the paid price, and that could explain why we've had food CPI so much higher here than we've seen in Europe. There's your little macro minute of this week's podcast.
That's a nice little nugget, isn't it? A nice little nugget of information. At least it's nice to know the ONS are moving into the 21st century. Shame about their working practices, eh?
I mean, when did this first happen in terms of special pricing for club cards? It must be 2 decades ago.
Oh, it's years. I mean, Nectar card, club cards. You got your Waitrose cards. You get little discounts and what have you. I mean, sometimes there'll be a discount on a particular product that you buy every week, 1 week. And other times you'll pay double the price. So to get around that, what I'll do is I'll double up on the half price week and leave it a couple of weeks and then double up again. I mean,
but I don't know why it's taken the ONS that long. Anyway, they're a shambles.
Anyway,
Tesco's.
Anyway, so Tesco's.
Now I've gone off on a massive tangent. We've got a clip for YouTube anyway. There we are.
You've completely thrown me now. Tesco's, I mean, their share price has actually held up reasonably well. It's off the peaks that it was in February, but it's still well off the lows from March. And they raised their guidance beginning of January. Having said that, obviously things have moved a bit quite since then, but they haven't come out and delivered any sort of trading update or warning to suggest they're not going to hit that guidance. So it'd be interesting to see whether or not they're able to hold on to the gains from the lows of mid-March in the wake of their full year numbers next week. I'll be very interested to, though, get an idea of where they see the next fiscal year.
Yeah, I think the guidance is really going to be the key thing for Tesco. Not only, can they live up to what they announced previously, but, give us a read on the wider sector. The other thing I would just say about Tesco earnings, and this kind of goes for all retailers, is you will undoubtedly see headlines around revenue, record revenue up X% year on year, et cetera, et cetera. Ignore all of that. The key thing to look at when we're talking about, you mentioned like this idea of profiteering and all the rest of it earlier on, the key thing to look at is their margins. I don't have the figures to hand right now because I'm horrifically underprepared. However, Tesco's margins have been essentially flat for a number of years now. That is a sign that they are not, deliberately trying to make more money out of whatever the latest crisis may be. There is no profiteering going on in the sector, and there almost can't be at this point because, as you alluded to earlier on, you've got the likes of Lidl and Aldi who are, basically forcing that price competition to take place.
And they're still opening new shops, Aldi and Lidl.
Yeah. Absolutely.
So they're out competing. Not only are they competing with Tesco's and Sainsbury's, they're competing between them, Aldi and Lidl. They're opening shops within, half a mile radius of each other. So it is pretty cutthroat out there. And I think that's significant. So
yeah.
And when I look at food prices here and I compare them to the States, our food prices are a lot cheaper.
And the data might now reflect that as well.
Well, let's hope so. When's that going to take effect?
From this print, actually. Because what's even more exciting than that is I've been invited to a webinar to hear even more about it.
Oh, God, mate. You better stock up on beers because I tell you what, I don't think I'll be able to sit through something like that without falling asleep. You need to get out more, mate. You need to get out more.
I can't. Look what happens there. I go red when I go out.
All right, well, on that bombshell, a
Saga.
webinar from the ONS. I'm guessing the ONS person will be working from home.
Well, presumably. I may ask that, actually.
Anyway, so that's Tesco's. So that'll be an interesting set of numbers. And, profiteering. Well, let's talk about that. Their full-year guidance is around about a group-adjusted operating profit of £3 billion. Okay. Their total revenues are going to be in the region of 65 to 70 billion pounds. That's hardly profiteering.
No,
and that's group adjusted operating profit. It's not net profit.
They are just seen as a bit of an easy target, I think.
Of course,
food prices have gone up. We'll blame the supermarket rather than external factors. That's basically what's going on.
Okay, let's look at Saga. It's not only an insurance company, selling insurance services, it's also a cruise ship company. A cruise ship company that I've had first-hand experience of, and whose share price in the last 12 months has doubled. Cruise ships have now become profitable, and that's all the more welcome given the fact that Saga was looking at selling its cruise business in 2024. I mean, I wonder if they're still thinking of selling it now, because now it's really adding value.
Hope not.
Oh, I would hope not either.
Although, actually, having said that, and I have zero inside intelligence on this one whatsoever, we have seen a worrying trend recently of units of companies that add value being spun off. You look at Unilever, you look at what's going on with ABF.
Yeah.
I don't think they're going to go down that route. They'd be foolish to do it, but a lot of companies seem to be doing it regardless.
They have a lot of debt. But that's a COVID overhang, and it was also an overhang of the fact that they built these brand new boutique ships in 2019 and 2020. The 2021 Spirit Adventure got delayed because of COVID. These ships are now starting to pay off big time when it comes to revenues. And the fact is, Saga are not exposed to the Middle East. They operate solely within the Atlantic Ocean and the Mediterranean, and obviously up north towards Norway and what have you. I mean, they do the round the world cruise, but that goes down around South America. So
again,
certainly in terms of the hotspots, they're not uniquely exposed to that part of the world.
No, and as you say, yes, they did have a significant amount of debt, but they've trimmed it by 100 million or so over the last year, and so that's moving in the right direction. It's not. It is a significant burden still, but it is being brought down slowly but surely in controlled fashion, which again should bode relatively well moving forward.
Yeah, ocean and river cruises delivered a load factor of 93%, which was 2% above 2024. Revenue growth of 13% in holidays, passenger growth of 11%. Broking is also doing well because they've just signed a deal with the Aegeus partnership to basically be able to deliver more insurance products. I think Saga's best days could be in front of it. I just hope that they basically optimize what they've done with both of those businesses and take that momentum forward and not consider selling off what is, to all intents and purposes, a very profitable and successful business on both sides. Anyway.
Indeed. Well, I guess the key question is, are you going to be going on another Saga cruise? Can they incorporate that into their guidance?
We won't be. Certainly not unless we want to go somewhere that we really, really do want to go, and Ruth hasn't seen anything.
Like the Northern Lights, like you did before.
Yeah, exactly that. Yeah. Exactly that. It was a means to an end, I think, in terms of going to the Arctic Circle. It's not exactly an easy place to drive to. So we thought, well, we'll go on a boat instead, it's definitely one of those things. Okay, US earnings season. Let's get cracking. I think the key thing for me, it's really about what it tells us about the US consumer. I think in terms of investment banking, if you haven't done well over the course of the past quarter, then you really got to be asking yourself some serious questions, because the volatility in equities, in bond markets, less so in FX market, but fixed income and equities should have done well for JPMorgan, for Citigroup, Bank of America, Wells Fargo less so. But again, Wells Fargo are leaning much more to wealth management, and that does appear to be doing well as well. So I think...
Yeah, I think the other thing with that, just before we go into like the specifics, is trading revenues should be really strong because of the volatility that we've seen, certainly over the last kind of 4-6 weeks or so. Investment banking revenues should be pretty decent as well, because actually not just markets have been volatile, but you've also had actually quite a lot of deal making going on. Quite a lot of IPO and M&A activity has taken place during the first quarter, which should be a boost on that front. So I think really the key variable is going to be the consumer side of things. And there's quite a lot of moving parts there, because you actually reminded me of this in your notes, where we've got this proposal for a cap on credit card interest rates that everyone has forgotten about, apart from your good self. You've also now got a huge energy shock coming in. What's that going to do to the consumer moving forward? You've got a labour market that's kind of not really going anywhere, as we've already discussed on the programme. Do we see greater credit provisions given the uncertainty that's on the horizon? I think that's really going to be the market's focus, because as you said, if your investment banking revenue isn't strong in a quarter where deal making's been really solid, and if your trading revenue's not strong in a quarter where markets have been really volatile, you're doing something wrong. It's the consumer side of things where stuff might actually be different.
I mean, Citigroup and Bank of America did post lower than expected credit provisions in their last quarter, Q4, whereas JPMorgan raised theirs. But that was also due to the fact that they integrated some new AI technology as well as the Apple Car portfolio into their business model. So, the challenges facing the various banks are sort of unique in some respects, but also not so much in others, shall we say.
Yeah. I guess the other one is, as I've knocked my microphone over, the other one is, I'm not having much luck today. The other one is private credit. Are we going to see, because Jamie Dimon certainly has been, exactly, very, very vocal about that. Obviously, Jefferies were majorly exposed and took a bit of a hit in their earnings on the back of that. Are we going to see any other concerns from some of the big bank CEOs about what's going on in that space? I think that might be one to watch too.
I think that's a good shout. I mean, that was something that I did overlook, I have to say, because obviously Jamie Dimon has been fairly vocal in that. So yeah, you're right. It's certainly something to pay particular interest to, and see if they make reference to it in their earnings announcements. Let's finish off with Netflix. Lots changed since the last time we spoke about Netflix, and the share prices have undergone a bit of a rebound. Not because of an improvement in their overall performance. Their Q4 revenues were pretty decent. The Warner Brothers deal fell through, and there was no break clause.
Well, and I think actually, do you know what? I would be saying that's a bit of a blessing in disguise for Netflix, because it looked as if they were biting off a little bit more than they could chew with that one. And the fact that Paramount Skydance, wasn't it, came in and sort of took that off their hands has done them a massive favour, and I'm not surprised the market's reacted quite well to that.
Yeah, I mean, and Warner Brothers also had to pay Netflix a $2.8 billion break fee. Basically, Netflix didn't have to pay that break clause. Yeah.
Well, yeah, I mean, for Netflix, that's money for old rope, isn't it? They've basically done nothing and been paid $3 billion.
Yeah, exactly. Because that fee was there in the case that the regulator overturned it. Now they don't need to, because Warner Brothers Discovery have decided, well, actually, we're going to go with a higher offer, even though potentially it doesn't offer a significant
and the other thing. Value. The other potential thing to look out for, and again, you've written this in your note here, so I'm just going to shamelessly steal it, is in order to finance the acquisition, they they pause their buyback. Now that they're not proceeding with the acquisition, do they resume the share buyback?
Yeah. I think they probably
you would
will.
expect that they would. It would be very, very surprising if they didn't, because you don't need the cash anymore. Our views on buybacks are relatively well known, but again, it just helps to potentially put a bit more of a floor under the stock.
That may also account for the fact that the share price has perhaps rebounded, because maybe there's a feeling
market's already just discounting that.
They're discounting, yeah, exactly that.
Yeah.
Okay, and that's due on the 16th. So that's pretty much it for this week, ladies and gentlemen.
Yep.
That 50 odd minutes has absolutely flown by.
Really, doesn't time fly when you're having fun and getting lectures on scanner data and how inflation works?
And there wasn't really too many rants in there either, was there? So
no, we've done well. We've been well behaved.
Indeed.
Give ourselves a little pat on the back for that.
Indeed. Well, on that note, best you go out and enjoy the sunshine, mate, while it's there, because apparently it's supposed to rain over the course of the next couple of days, just in time for the
wonderful.
schools to go
Summer's
back.
over.
Great.
Just as it's begun.
Yeah, indeed. And on that note, we'll pick this up same time, same place next week. So thanks for tuning in.
See you then.